good afternoon, and good evening, and wherever you are in the world, welcome. Welcome to another Monetary Policy Institute webinar, the second of 2024. The first was held only a few weeks ago on January 19th and featured a presentation by Eckhard Hein on conflict inflation. The Monetary Policy Institute was created in June 2019 when we hosted our first workshop in Talloires, France on the future of central banking. Following that workshop, we created a book series with Edward Elgar, which now has 8 published books. This is our first on the future of central banking. And the series is called Central Banking and Monetary Policy. As I said, we have 8 books on income distribution, the environment, digital money, social responsibility, amongst a few more. And we're expecting at least 5 more in 2024 on financial fragility, monetary policy implementation, dollarization, and soon the very first book ever published on monetary policy and gender. In 2022, we created the Monetary Policy blog, simply the Monetary blog, which has been so far very successful. We publish a weekly blog on Mondays, and we believe there is such a space for critical thinking about monetary policy, pushing the boundaries of our understanding on money, interest rates, inflation, and monetary policy responses. This brings us to today's webinar. Our topic, post-pandemic inflation. Lots to discuss. There's lots of agreement and lots of disagreement. Our guests today, Claudia Sahm, founder of Sahm Consulting and formerly of the Federal Reserve Board. Joe Stiglitz, professor at Columbia University and winner of the 2001 Nobel Prize in Economics. Now, inflation peaked in June 2022 and has been coming down ever since, with a few bumps along the way. Predictably, the Federal Reserve and other central banks have responded with an aggressive policy stance, monetary austerity, starting to raise rates in March 2022. Central bankers and others are quick to point out the success of monetary policy, yet I think the timing simply does not add up. With the known lags in monetary policy, how can interest rates that are beginning to rise in March 2022 lead to a decline in inflation only a few months later? For me, there's other stuff going on. And to discuss this other stuff, our guests today both have advocated the transitory nature of inflation, the result of bottlenecks, the increase of some commodities, including oil, supply chain disruptions, and of course, supply side factors, profit inflation, greed inflation, sellers inflation, thrown in for good measure. I'm a big believer in post-pandemic being transitory and giving credit where credit is due. And both of you, as I said, have come out claiming that you were right and that you deserved a victory lap for claiming early on that inflation was not going to be long-lasting. And I think, Claudia, you are the one who coined the expression team transitory, or certainly was one of the very first to use it. So let's touch on this transitory nature of inflation. And for me, anyone who understood or who understands the real causes of inflation should have, from the beginning, concluded that the post-pandemic inflation was going to be transitory. And on this note, a shout out to my post-Keynesian colleagues, my MMT colleagues, who understood this from the very beginning. So the first question, when did you say, or when did you realize that inflation was going to be transitory? What was your reasoning for thinking this at the time? We'll start with you, Claudia, and then we'll go to Professor Stiglitz.
And the reason automobile prices were going up was a shortage of chips. And that's an example of a supply chain shortage. Now, raising interest rates is not going to create more chips, and so it's not going to solve the automobile problem. Now, it is true, just go focus on that as one example, and I'll give some more. If you kill demand enough, you can get the demand for automobiles back in line with supply. But that approach to thinking about automobiles and inflation is one that's not very helpful, because the destruction to GDP would be enormous. So that's not the best way of going about attacking auto inflation, inflation that arises from a shortage of automobiles, of chips for automobiles. As we look at the whole array of what happened, it wasn't just supply shortages. There were also huge demand shifts. Example was people wanted to live in different places. New York is a wonderful city. It was less attractive if you couldn't see anybody. And so people wanted to move out to Hudson Valley or Southampton. But there are asymmetries in price adjustment that we can try to understand. Where demand was higher, prices went up a lot. Where demand was reduced, where there was excess supply, prices didn't go down. But there was not really, the problem was not excess of aggregate demand. It was really particular demand. Now, this illustrates why raising interest rates was not the right solution, because if you have a supply shortage of houses and it was going to be longer, let's say, we don't know how long, we didn't know how long COVID-19, but if it was long-term, you wanted to build more houses in Hudson Valley. Raising interest rates is counterproductive. It's not just that it's not the right medicine, it's a medicine that makes things worse, because you wanted to construct more houses in Hudson Valley, couldn't do it easily with high interest rates. So that's why it's really important to get an understanding of the origins. Now, I thought it was going to be transitory, and it was transitory. Understanding the speed of adjustment, the irony of it, I was on the side of markets respond, but how fast they respond is a complicated matter. In some cases, we saw very fast responses. There was a shortage of lumber. Lumber is not a complicated product. And in a few weeks, we got more lumber because we didn't have a long supply chain. We could make it in the United States. And that gave us hope that maybe in other cases, it would be fast. But a lot of our supply chains are complex. To produce A may require B, B requires C, and C may require A. And getting that tangle sorted out is not easy in a world of globalization. We had China responding very slowly to COVID-19, having shutdowns, and that meant, again, interruptions. That particular part of the supply chain couldn't respond quickly. And so it was impossible to say how long it would take. But what we could have figured out, and those who were on the team transitory, to use that term, knew that, take the war in Ukraine, price of oil went up, but inflation is the change in the price. Price goes up from 80 to 120. That's a big deal. But would you expect it to go from 120 to 180? Another no, because there are substitutes. The market will respond. We can produce renewables at 40. And so the discrepancy between the backstop technology and we can produce fracking gas at a relatively low price. So there was every reason to believe not only that the prices wouldn't continue to go up, but that there would be disinflation. And that's precisely what has happened. Finally, one more thing. The interruptions in supply chains had one more effect that hasn't gotten as much attention as it should. Firms had market power.
Mhm.
Normally, when you raise your price, you worry about competitors coming in and taking your customers. We don't live in a world of perfect competition. We live in a world with customer markets, monopolistic competition, and all kinds of imperfect competition. But you raise your price, there's still some competition and people rush in. But you knew that if you were a firm, you knew you had better supply chain than your rivals. You had more market power, temporary market power. But the nature of capitalism, it's a little bit ruthless. And the nature of capitalism is you take advantage of that market power. And Mike Consul at the Roosevelt Institute and his colleagues showed very, very clearly those sectors and those firms with market power took the opportunity to use that market power to increase markups. But again, that there was no reason to believe it would be permanent. If it were, we really needed a new antitrust law. We do need a new antitrust law, make that clear. But there was no reason to believe that monopoly power would remain at that high level. So markups would come down. So there were a number of reasons to think of the supply chain interruptions, the demand shifts, the high increase in markups. All of these were transitory. But as Claudia said, we had no way of knowing how long the war was going to last, how long the COVID-19 was going to last, what form it would take. So no one could predict with any reliability how transitory this inflation would be.
Well, let me bring up a quote because I believe that Jerome Powell was probably the original team transitory, right? He said in 2021 in June that inflation was going to be temporary and sort of argued that there would not be any increases in interest rates. So what happened to him to change his mind so dramatically? Because it led to one of the most aggressive monetary policy stance in recent memory. So what happened there? Why did he and others of his ilk change their minds?
One of the big reasons that the Fed changed its stance and started raising aggressively is it while there were still sectors that were clearly affected, so the automobiles, some other like durable good things that had clear supply chains, we started to see as 2021 went on more sectors being affected. So you started to see it in services inflation. So you can't tell the supply chain story there. I think we are seeing how that was very much related to a lack of labor supply. So we had, labor shortages that people had left because of COVID. We'd stopped processing immigrants, right? So there was a piece to that I think makes a lot of sense, even in a COVID-driven story. And they couldn't wait, right? To me, because you start to see that spreading, and there were big push to demand. I'm a huge proponent of the rescue plan, the American Rescue Plan, that was very contentious among even Democratic leaning economists. And I mean, the Fed quite remarkably kept rates low in 2021. Inflation was coming up. There in late summer, it started to come down. So we're like, okay, it was transitory, we made the right, and then it moved back, and then it shot back up, and then as it did that, we had uh Delta and Omicron and then Putin. So there were events behind that shooting back up. But once it started becoming broad based and they had kept it very low, the Fed's like, we need to get at this. Now I am even with this background of I think this was COVID and Putin and temporary, I am supportive of the Fed raising interest rates in 2022. I think they went faster and went more than was necessary. Those 75 basis point increases 4 in a row, that was pretty rough. I would have put them down to 50 because it was really disruptive. And I mean, anyone around the world knows that the Fed going as fast as it did, and then central banks coming after them, this was so there was a large increase in interest rates. It was done very quickly, and it was totally unexpected, right? Because the Fed, it really wasn't until the end of 2021 where they're like, we're going to raise rates. So that created some instabilities in financial markets that largely we've weathered. But yeah, that was, and I think there was a press conference sometime late last year where, I mean, Jay was like, yeah, it was transitory. I mean, he did say the word in a press conference. So, I mean, the Fed did see these disruptions as temporary. There was a lot of concern about they were spreading in ways that would not be as temporary and much more into demand, which is the Fed's thing. So, but I don't give them, in my mind, this cycle has next to nothing to do with the Fed. And they better not make it about themselves on the home stretch in terms of like taking away the soft landing, because a lot of it was, there were disruptions, these supply disruptions. Like, Jay did not unload the docks in LA. He didn't take a second job. He didn't, go and make, microchips and, so there were all these things that had to happen that weren't about the Fed. The Fed is there as a supporting actor. And this, again, is why I think it's so important to go through these lessons, because there are individuals who want to make it all about the Fed. Like, the Fed was what brought this inflation down. And I think we walk away with this from missed opportunities to, we'll see other disruptions in the future that hit on supply. I mean, we do already, but this one was there were a lot of them all at once.
So I agree with Claudia. Let me say, I think keeping interest rates low in 2020 and into 2021 was the right stance viewed from a risk perspective. Remember, this was the biggest shock we've had to our macroeconomy in a long time, and a lot of uncertainty. And I think the judgment was very much that 30% peak unemployment. I mean, this is a big deal, and that you needed all the support of fiscal monetary policy that you could muster to make sure that there isn't significant scarring and large fractions of the economy suffering. So the stance was right. As we became able to deal, so we were dealing with it, fiscal policy was moving in the right way. We'll talk about that, I think, a little bit more in a minute. It did make sense to normalize interest rates. They have been at an abnormal zero level, and anybody who thinks about the cost of capital, zero is not the right number. And so moving from that zero number that had been there since 2008 made a lot of sense. But the point that Claudia made, by going so fast, it created real disturbances to the financial market, which we saw serious consequences at Silicon Valley Bank. And look, we should be clear, if the federal government hadn't used those emergency powers, we would have had it could have been very serious. We extended deposit insurance. We discovered that the Fed was not doing good stress testing in the way they should. I mean, it was actually a very embarrassing moment for the Fed to cause this financial disruption, and then to admit that it didn't even have the tools to assess the damage that it was doing, and it wasn't doing the damage control was at the very end and required emergency powers. It was a real, I think, should have been viewed as a very embarrassing moment for the Fed. The reason I think that for the turnaround was mostly the financial markets. they started pounding. Now, let me make clear, as I said, didn't make sense for them to go from 0 to a more normal interest rate. It should have been clear that if you have this high inflation, even if transitory, it will seep into core. It will, the labor shortages that were particularly acute in like hospitality sector, where the firms have paid outrageously low wages. Why would workers expose themselves to risk in the midst of the COVID-19 at those low wages? So it was predictable that those wages would go up, and a good thing that the wages were going up. That should not have been something to dampen down the economy. So, it's all part of the trauma. We had a big trauma, and we needed to respond, and that we would face some inflation, and it was right that they raised interest rates. They should have to a more reasonable level, and it should have been done more carefully, more slowly. But the main focus was not what I just said, a careful balancing of what was going on, an assessment of demand and supply and what was going on. It was pressure from the financial markets with words like, we're getting behind the curve. And one central bank browbeating other central banks for not stepping up to the plate. All these metaphors, which, from baseball, macho, you're supposed to be dealing with inflation. And so finally, let me say, inflation is fighting inflation is in the DNA of central banks. It's part of their, in Europe, it's the main focus of attention. In the United States, it's one of the objectives. So it's understandable that they would be concerned. But the question they should have asked is, what is the source of inflation? What can we do about that? And what is the best way to respond? And that includes the points that Claudia made, the pace of change.
Yeah, thank you. Listen, you both touched on a lot of things that I want to talk about, a lot of things to discuss. But Professor, I've made that argument before that I think the Fed started to raise interest rates because it was being accused of being non-credible. And those arguments were being made, and you sort of said the same thing. So I'm glad that you made that argument. And I want to touch on something that Claudia said about demand inflation. So we've heard a lot during the COVID about pent-up savings and the Biden plan. It's a narrative that's out there that it was all driven by people who couldn't spend during the COVID, and now they're going out and they're spending and you saw the savings rate increasing. We saw that. And then the Biden plan. What are your thoughts on those elements as a source of inflation?
Yeah, so that was a question that I was very interested in, and so with a team at Roosevelt Institute, we looked at aggregate demand and compared it with CBO and other estimates of aggregate supply. So it was trying to get a view of the aggregate. As I say, I began my discussion by looking at sectoral impacts, but question was, what about the aggregate? And what it was very clear is, if you look at the initial stages, consumption was down, people's savings rate went up, but also investment went down. And so we can calculate C plus I plus G plus net exports. Some of our trading partners weren't doing very well either. You look at the whole thing as you would in an elementary economics course, and except for a very, very brief moment, aggregate demand was below potential supply. So, and if you look at the timing of inflation, it doesn't correspond with that one little period where it exceeded aggregates by a little bit. It's very, very hard to see the Biden plan as being the source of the problem. In fact, if there hadn't been that kind of support, fiscal support, I believe we would have had a much deeper economic downturn. It was really important support for the economy. And then if you look at the disinflation, what we've had since then, the disinflation doesn't correspond to the what was said by people, the same people who were worried about inflation. Some of them said we're going to have, looking at the conventional Phillips curve, we're going to have 7.5% unemployment for maybe 2 years. Well, we've seen the disinflation occurring again, with unemployment remaining at the almost unchanged at 4%, around 4%. So I think this shows very, very clearly that what the driver of both the inflation and the disinflation was not aggregate demand, and in that sense was not the Biden plan.
Thank you, Claudia.
I would absolutely agree. I was a huge proponent and worked with Congress on everything from the CARES Act through the rescue plan, and then some other pieces after that. But like that entire run was so important for this recovery, and particularly in the labor market. We had after the Great Recession, policymakers went small, right? And we had a grinding recovery. Now, these two recessions are different. So I don't want to say you can compare, apples to oranges here. And yet this time we did big fiscal. Like the United States put over $5 trillion out in relief packages in a year. A family of 4 within that year, 2 adults, 2 children, got $11,400 in stimulus checks. I've worked a lot on stimulus checks. That's my big area of research. That is almost 20% of median family income in the United States. That's like 25% of Black families' median income. I mean, that is just like, wow. Like I had done a lot of research on how important and useful those checks were to provide relief, to stimulate the economy, help people pay down debt, put a little bit aside. And even I was totally blown away by what Congress was willing to do. The United States was the only of our peer countries that had the rescue plan. Like that last piece under Biden, that was very contentious. I mean, yeah, there was, lots about potential output and this, that, and inflation. And I mean, really, that was the hardest. I lost a lot of friends, professional friends, over those $1,400 stimulus checks. I was right. That's what I'm really happy I'm right about. And what we learned now is that it was both that kind of money when we put it out, it's both stimulus and it was very effective. The labor market really came back fast, and it's relief, right? Like it was helping us get to the other side of it. We were going to have high inflation anyways. In the United States, a lot of people who normally don't had some money on the side or a bigger paycheck to deal with it. So though stepping back, big picture, one of the lessons, and I'm not surprised, but we like see it in the world now, fiscal is more powerful than monetary policy when a recession strikes. And frankly, the big fiscal this time kind of like mucked it up for the Fed. Like a lot of people paid down debt, delinquencies went down, they have saved, like they don't need to borrow. The interest rates, cash flow is great for businesses. They don't necessarily need the loans to be, like that's not the determining characteristic. We would have been in a bad place if this inflation really had been all demand and really had been caused by the rescue plan. The Fed would have had to go in so big. And I know many of you, I'm sure, have worked in this space, but in my impression, having worked at the Fed as a macroeconomist, like we spend a lot of time, there's a lot of research in the Fed, in academia on how to do monetary policy. There's much less on fiscal policy because it's grubby. like it's in the politics. And yet, if we now know that's like really, it's really powerful, we need to make sure we do that well. So
Thanks. I mean, I'm not a big fan of using monetary policy. I think it's a blunt instrument for reasons that the professor mentioned. I'm a big fan, however, of fiscal policy. I'm a Keynesian after all. But so let me sort of piggyback on something that you've both alluded to. Could we have not used fiscal policy here, or some fiscal measures, um, to go after inflation, through some sort of price caps or maybe, other type of measures rather than just relying too much on monetary policy?
Well, to the extent that we had supply chain problems, to the extent that we had the demand shift, to the extent we had labor shortages, yes, of course, we could use fiscal policy. Now, I'm not, I don't think price caps in our complex economy would work well. And I would discourage the use of that. But we had a brief mention before of the temporary labor or the labor shortages that showed up in particular places. If we had better family leave policy and childcare facilities, many women would be able to join the labor force. And one of the things that's very marked is the low labor force participation of women in the United States compared to many European countries. We used to be a leader, and we're very much a follower. So that's an example where we could have done something, I think, relatively quickly. In the area of energy, we could have guarantee, one of the reasons why markets at first didn't respond as strongly and quickly as we might have hoped was there was a lot of uncertainty about how long those energy prices would remain high. Nobody knew how long that war was going to last. And, if they knew it was going to last for 2-3 years or as long, they might have been willing to invest, but it might be a short-term price spike. So if the government had used fiscal policy to give a guarantee of a price, I think there would have been a stronger supply side response in energy, and would have been great if we had directed that towards moving faster to renewable energy. Some of that could be expanded fairly quickly. We did take actions like on the ports. The Biden administration did take strong actions to try to address some of the specific supply side problems. In the case of housing, we could have made access to credit for housing, particularly for lower middle income individuals, higher and lower interest rates for that particular category. So that would have alleviated some of the supply side problems. And by doing that and committing to do it going forward, people would realize that future prices would be lower, and that would get reflected in the price of housing today, making housing more affordable. So yeah, there were a lot of things we could have done in fiscal policy had we had the right Congress.
Claudia?
So when I talked to members of Congress, I had the opportunity to brief House Democrats early in 2022, right after Putin invaded Ukraine. And I told them that you need to move heaven and earth to get gas prices down. I know that is not in your long-term, vision. It's not in mine either, but like people cannot adjust that quickly to, that something that a lot of people need to get to work. And, the administration, they did. I mean, they opened up the Strategic Petroleum Reserve. They did, in fact, create contracts that had a price at which they would buy back the oil to fill the reserve. So that was a pretty novel setup that did help producers, like incentivize production. Under Biden, we have the highest level of oil production ever. So the administration does not want to take a victory lap for this for reasons I can't totally understand. But I mean, that was a big deal. So that was one area. And there were other places. I do think, and I, underscore what Joe said, we need to look at this as, oh, wow, our economy is not resilient. Problems that we came into COVID with, like not enough housing, COVID just blew it up. Like not having good, family leave or childcare, COVID just blew that up. So then we should say, okay, well, let's, silver lining here. Let's think about what we can do to do it better. The answers to those questions, the policy ideas are out there. It's just the will to get them done is not here. I mean, to get them through Congress. But this is, that's another piece where we can just make the economy more resilient next time. And yet they've got the one frustration, this one of many in talking with members of Congress or the White House, is you cannot say, oh, there's inflation, the Fed's got this. It's like, no, this is not like your regular inflation. You all actually have tools that the Fed does not have, very targeted tools. But there's this view, it's like, oh, inflation's here, oh, it's the Fed. And I think that's something I think that slowed Congress down, and maybe even like they didn't even try in some cases because it was just like, oh, we don't do inflation.
Yeah.
Can I make two more comments, amplifying things that Claudia said? The first is that there are some fundamental problems of our economy and resilience. And some of the directions in which the economy has gone over the last 30 years have made it less resilient. Just-in-time inventories has some advantages, but when things are normal, but is not a good way of running an economy if you're going to have some shocks. And so in the era of great moderation where nobody expected shocks, it might have worked, but we're in a very different world. I'm not sure how we move the economy to become more resilient. I think it's a really important thing. And I think many firms are beginning to think about it more. One way I think about this analytically is that there's a distortion in our economy because we don't have a price for carbon. There's another distortion in our economy because we don't really have good prices for risk. And so firms don't really, it's often been commented that modern capitalism is too short-sighted, and part of being short-sighted is not thinking about some of the risks that you face going forward. The second thing is something I mentioned very briefly before. The monetary policy could have been more helpful by trying, rather than being, it's normally a very blunt instrument, not a very good instrument when you have this very disturbance that affects different sectors so differently. But you could have had special allocations for housing, for instance, in those places in the country facing housing prices going up. So the Fed has, you might call, quasi-fiscal tools, but the ideology that we don't do that kind of thing in the United States, other countries have done that kind of thing, prevented us from doing that. So we used a blunt instrument that actually made inflation worse.
Mm-hmm. Yes, in fact, in Canada, the Statistics Canada came out and said that the high interest rates contributed to inflation by raising rents and et cetera. There's a great quote that Keynes said in 1942 at a BBC interview where he says, anything we can do, we can do, And I think that's a very good quote. There's so much I want to talk about. Before I pass over to my colleague, I'm going to ask one more question because this was an article that came out last week, I think. It was in Bloomberg. You might have seen it by Clive Crook. He described all this transitory versus inflation, etc., as a tribal dispute. Is that what it was, or is there something more fundamental going on?
That's kind of how macroeconomists roll. I mean, like we have different models, different theories about how the economy works, and often, and I think, you know, in this room we probably have a lot of different models and theories we bring, and you know, you just kind of duke it out. There are reasons that I think macro is in the policy world, macroeconomists have such an important role, right? In terms of like, especially in a time of recession, like the fiscal policy. Like, you know, I'm working on fiscal packages that are like $2 trillion. Like this isn't some little, and a lot of it can even be framed in like how big and what's the multiplier. And, you know, so I mean, we're talking about very important. There are other parts of economics like this too, but I think that's part of where the stakes are high in macroeconomics. We are not only tied to DC and policymaking, we are also tied to financial markets and corporations because of the decisions that are made. And I don't know, we just seem to be a rowdy bunch. So when Clive said that, is I took issue with his, oh, you're all tribal, we should set aside right and wrong. And I'm like, look, this is actually, there's something more fundamental here. It's about the lessons learned. And as I understood, I was a little too young for this, but in after the whole I mean, the recessions and high interest rates and everything came down, as my understanding was, that 80s was one of the biggest periods of debate in like recent macroeconomics, you know, really like trying to hash out who was right and wrong. And there were some big changes in some places where like Keynesian type stuff was less in regard and maybe more the real business cycle. We didn't have that after the Great Recession. I mean, there was a lot of like, oh, well, we had that model. Oh, and I'm talking about like in mainstream kind of policy circles. And it was a lot of people who were involved in going small were there rewriting or recasting. Like everybody have an opinion about what happened then or what's happened now. And you don't have change unless you really get in there and argue. So I felt his was a little bit, and I was also kind of like, hey, where were you in 2022 when I had to see, you know, the Larry Summers, the Jason Furman, he's a dear friend, he's lovely, out like on all major news networks being like, we were right and they were wrong. Like, I didn't hear anybody telling them to be chill to see what actually would come out on the other side. So it just felt a little bit like a double standard and also letting the traditional viewpoint or the kind of on high viewpoint just, you know, rewrite all of this. So I don't know, but you know, it would be awesome if we like worked together and we're collaborative and I said this wrong and you said, you know, like, but that doesn't seem to be our culture as macro. I might be wrong. Joe, tell me I'm wrong, please.
So let me say, it is in a sense tribal, that there are big divisions within economics of how they see the world, but it's not just a tribal matter, as Claudia said. It makes a very big difference about what you do. And whether you see the world as one where the appropriate policy response is to raise interest rates, or the appropriate policy response is to focus on fiscal policy. These make very big differences for the overall economy and for the lives of millions of people. So it's, you know, to say this is just a fight, a tribal fight, is, I think, wrong. But let me try to emphasize why there's such strong divisions and illustrate what those divisions are. It is very different conceptions of the way the economy works. And we've been talking around the edges of some of those differences. One view is the economy is basically competitive, efficient, a neoclassical model, resources move efficiently from one place to the other, no market power. And the other view is the economy is rife with market power that can change over the business cycle, that there are all kinds of imperfections, that, you know, after all, unemployment is in the standard perfect markets model, real business cycle, there is no such thing as unemployment. And, you know, to be fair, the advocates of real business cycle actually believe there's no such thing as unemployment. They're just people enjoying leisure, and that we mislabel it as unemployment. You know, and I look at the suffering. People usually, when they're enjoying leisure, look happy, and that's not true of people who are unemployed. So I think, and that's then related to politics. It's so important because this is political. If you believe the market is efficient, you don't want to intervene. So it's going to adjust on its own. If you think markets don't always work perfectly, you say you need government intervention. There are credit market imperfections, there are risk market imperfections. The markets are often not resilient. The irony in this particular case is that some of the people that Claudia referred to, both at one point think the markets work efficiently, but then on the other hand, often seem to want the government to come in and bail out the banks and uh, talk about it's going to take a very long time for the economy to recover. One of the ironies in the current context was I had more faith in the market than many of the people who were saying on the other side. One of the reasons that I thought things were transitory is I thought markets would respond. And the other side seemed to think that markets would respond. So I found it very, very peculiar that people who were pro-market all of a sudden became, oh, the market's not going to be able to deal with this. I think they have an incoherent view. And I think some of that incoherence is underlying this is a political agenda. And the core of that political agenda is trying to say the government shouldn't do very much. And that goes to the criticism of the Biden plan. And we talked about how effective the Biden plan was. One of the things that Claudia didn't mention was it brought down childhood poverty rates by 40 to 50% in 1 year. I mean, that's a major achievement if you have a view of, if you are concerned about inequality. So I think you can't separate the economics here from the politics. And so I don't think the labeling it derisively as just tribal is really wrong.
Thank you. Thank you very much. Glad we touched on that. I'm going to give the last few questions to my colleague, Sylvio Kappes. He's an assistant professor at the Federal University of Alagoas in Brazil. He's the associate editor of the Review of Political Economy, co-editor of the Elgar series on central banking and monetary policy, and he's currently co-editing 2 books on monetary policy implementation and on dollarization, which a year ago would have been, why are we bothering with dollarization? But now, back in the news. Sylvio.
Thank you, Professor, for introducing me. I want to ask a question, taking the lead that Professor Joe Stiglitz has taken, talking about inequality. So there is abundant evidence now that monetary policy has distributive effects. It affects differently women than men and Black people than white people. There is abundant evidence that contractionary monetary policy disproportionately makes Black women, for example, more unemployed than white men. And when monetary policy is expansionary, these people does not get the jobs back. So there is like a long-term effect here. So this said, can we say that there are some winners and losers from the 11 increases in interest rate that the Fed has done?
So again, I'm of the opinion in this cycle, the Fed is really a sideshow. right? They're absolute, though the place where good things have happened is where the Fed can do some good. Like what you were talking about, if you have expansionary monetary policies, so you keep interest rates low, and they did in 2021. They helped then with this. Then that's where, if you get the labor market going, well, when you get it going, you bring in the people on the margins, right? So that's where the Black woman in this particular case, in this cycle, like that big fiscal was really important, above and beyond, way above and beyond the Fed, in terms of getting the labor market really going. There's some really excellent, and we're starting to really be able to document it. So Aaron Dubé has some very nice work, I think maybe with David Otter, co-authors, that's come out recently showing that in this labor market, we have seen a compression of the real wage inequality that like had been growing over decades, right? So it turns out a really good labor market is really good for a lot of people. In last year, we saw women's prime age employment rate hit an all-time high. Even like Black men's labor force participation hit an all-time high. Like we saw, and lots of immigrants coming into the workforce. There were so many ways that, and I think importantly, it's not just about the jobs. These were like better jobs. Like the first wave of jobs that came back were full-time jobs. And those are just better jobs. After the Great Recession, it was the part-time that came back, right? And so like they're better jobs. You had these big wage increases, particularly at the bottom. You had a lot of people quitting jobs, going to better jobs. Those are the wage rates. So we saw how good a full employment, not everybody has a job, not everyone is doing well, but like a really cranking labor market. We even saw some bargaining power for workers and some of the unions, and the wage increases even outside of unions. Outside of unions, there was no change structurally to keep that going. But we are seeing what a really good labor market can do. That is where, with the Fed emphasizing their maximum employment mandate, how important the decisions they make about monetary policy are for the labor market, that is important. I will say, well, I often joke about over the last couple of years, the Fed's been waging a war on workers, right? Because they keep like, oh, wages have got to come down, so inflation. And I've been saying for a while, and it turned out to be true, the Fed lost, right? The workers won here. We still have a very strong labor market. So, but I think if it were just the Fed alone, this could have had some negative effects on the labor market. If the labor market's not good, it's not good for the people on the margins.
Let me try to parse this out into two ways. One is what Claudia has emphasized, the effect of monetary policy or any policy on aggregate demand and therefore unemployment. And unemployment is bad for especially people at the bottom. I mean, we know that. And one of the things that upset me when Powell talked about a target of 5% unemployment, he was going to try to, he said, fighting inflation is painful. Well, it's not painful to the bankers, but it's very painful to the workers at the bottom. And if you're talking about targeting, for a government public official saying, I am targeting 5% unemployment, what does that mean? Well, usually the African-American youth unemployment is 4 times the average. Sometimes it's even been 6 times the average. 4 times, that means I'm targeting a 20% unemployment rate for African-American, or if it's 6 times, even higher. That's going to scar those individuals and our society. So that way of framing it is really wrong. Another way in which the Fed often frames things that I think is wrong, and Claudia was hinting at this, is they get very concerned when wages go up too fast. And when wages go up too slow, they don't seem to be so concerned. What we should be concerned is there are periods in which wages go up slower than prices and real wages go down, and then they go up faster. If every time they go up faster, you shut down the economy, you have this asymmetric response, which is a ratcheting down of real wages. And the result of this is the share of labor goes down, and you're going to wind up with a higher average unemployment rate, which is what has been happening over the past when they've had the period of inflation targeting. So what I want to distinguish here, though, is there are these effects from aggregate demand, these effects from the way the Fed formulates its policy, how it thinks about it, from the way the direct effect of monetary policy. As Claudia said, in this particular episode, those direct effects are of second order importance. But in others, they become of first order importance. You know, let me just highlight two, one of which was relevant here. When you raise interest rates, you have effects on different sectors. And those sectoral effects have effects on the people working in those sectors, very large, but also on those who buy the goods produced in those sectors. And we've made reference a number of times to the housing sector. Very important sector. You raise interest rates, you make housing more expensive, you make it less accessible. So that's a direct way in which the well-being of our citizens are hurt through monetary policy, and how our economy is in effect getting distorted because it's going after one particular sector. In 2008, the over-reliance on monetary policy had another effect on inequality in our society, which is that very low interest rates hurt ordinary savers who depend on bonds, US securities for their retirement. But at the same time, the people at the very top who own the stock, the equities in our economy, those low interest rates cause a stock market boom. So that, who owns the stock market? The very rich, overwhelmingly. So that was an instance where the relying on the Fed led to increased wealth inequality. And a better balance between fiscal and monetary policy would have alleviated some of these, I think, very bad effects on our society.
Thank you, Professor. I want now to touch on a subject that we have not mentioned much today, which is the Phillips curve. And my question is quite simple. Where did it go, and how badly it is for monetary policy if we do not have a reliable Phillips curve?
So the Phillips curve in its simplistic form, so just looking at prices and unemployment, that was the typical one looked at, that it wasn't up to the task. I'm being as polite here as possible. Because it really, that logic, it's about demand inflation, right? Unemployment is a stand-in and tells us something about what is aggregate demand, right? And so it's this trade-off that you have to have less demand to get less inflation, right? Okay, fine. The logic makes sense, except there was a large piece of this that was supply-driven inflation. And even some of the demand piece, like the pent-up demand, this was, I mean, you could only do so much revenge travel, right? Like this was not, it was going to work itself out to some extent. Okay, so there are more sophisticated versions of the Phillips curve, which I have been reminded of by fellow macroeconomists. I mean, the new Keynesian Phillips curve, like there are capacity to put supply shocks in, all fine and good. The thing is for a policymaker, you have to have a tool that you can use in real time. You don't get to go estimate after the fact what were the supply parameters for it, or the coefficient, how much curvature there was. You have to have it so you can use it in real time, and it needs to be stable, right? The thing about the Phillips curve, if you just took the simple inflation versus unemployment, is this thing like it was flat for decades before. Then in like 21, early 22, it had a slope. And then after that, this thing is vertical, right? It's just inflation is dropping with unemployment staying low. And it's like, okay, if you had a tool where you knew all those things were going to happen, like these coefficients, fine. But like, we don't know this when you're using it. So it's very unstable. You cannot do policy, or you should not do policy off an unstable framework. And frankly, like there should have, if nothing else, there should have been some attempt to say, okay, this piece is supply, it doesn't follow that logic, and this piece is demand. I mean, there's a lot of literature saying you have to be very careful with the Phillips curve when you have supply driven inflation. So this thing, I mean, I don't think it's suited for the task of monetary policy. I had Paul Krugman at an event last year ask me, he's like, well, if not the Phillips curve, then what would you have them do? And I said, well, let's start with common sense. I mean, like, I don't have an answer for what, but it was so clear it wasn't what they should be doing. And it was being used to make, I mean, Larry Summers, made this very openly, but this was not, there were a lot of people that agreed with him that we would need a recession, a relatively severe recession, or actually severe recession, to get inflation down. If a policymaker had taken that to heart, like the Fed knows how to cause a recession, they can do it really fast, right? And that's not been their policy. That hasn't been their stance. They did think we needed inflation to get inflation up. We would see unemployment drift up some and growth would slow, but they never had anything that was like this, horrible scenario. But like, there were people that believed that, right? And that oh my goodness, like that is not how we should be doing policy. And so now we have an example of, well, that actually didn't turn out, right? We didn't need a recession. Whew, everybody should be happy. It's also been like, hey, we should have known that in the beginning. Like, you should have known that tool was not to be used for this. But we learn now, people ask me, oh, so it's going to get set to the side in the future. I'm like, no, this is an absolute zombie part of macro until we come up with something better. And maybe that is a better specified, more Phillips curve that has more to it that we can fine tune. But yeah, no, I don't, it was very frustrating. I'm glad it was wrong. And we got to come up with something better.
Let me, I agree with everything that Claudia said. Let me just add a couple points. The Phillips curve has exhibited a lot of instability before this episode. There have been, people have written books. The Phillips curve never existed in some sense. It took a lot of data mining to get a Phillips curve. So with good data mining, you could get it, but it was not a good predictive function that you could rely on policy on. But I want to emphasize 2 points. The first is, this was a unique event. We don't have pandemics all the time. So you couldn't put in a dummy variable for pandemic and say, whenever we have a pandemic, this is what our Phillips curve looks like. It would, and everybody agreed that this was a unique event and we couldn't know what was going to happen. There were stories that the young people, having spent 2 years in behind Zoom, would never go back to work. There were others that said, this was a temporary aberration. They wanted to get back into the workplace. They want people, humans are social animals. So, to be honest, nobody knew for sure where we were going to be. But that meant there was no way of having a reliable Phillips curve. So what do good policymakers do? Well, they act with some degree of caution and risk analysis. So the way I talk about risk analysis is the following. If we undertook some of the fiscal measures we talked about before, like better family leave policy, policies of childcare, more renewable energy, no matter what happens, our society is better off. Even if our worries were wrong, and it was not, our analysis was wrong, we've done something that's beneficial to our society. But if the other analysis was wrong, Claudia said it, we would have scarred the economy for a long time, and we would have lost an enormous amount of output. Now, everybody who does policy should be engaged in that kind of risk analysis, and those guys didn't do it. And I think that's a fundamental error. Now, that leads me to a broader critique of modern macroeconomics, which is the models from Real Business Cycle, DSGE, employ a framework in which there are well-defined shocks with well-defined probability distributions with known frequencies. Let's be honest, we didn't know about what is the probability distribution of the length of a pandemic, of the length of a war in Ukraine. We have no regular probabilities. These are unique events where what we have to draw upon is knowledge that we have. We have knowledge. We know, as Claudia pointed out, fiscal policy can be very effective. It can be very timely. We can withdraw it. We can design it. We can do a better job of designing monetary policy as well. We need to act in these cases where there is a lot of uncertainty, deep uncertainty. We need to act cautiously with an awareness of the asymmetries associated with the damage, the hysteresis effects. And that was what was so lacking on those who wanted us to have a deep recession. And thank God that disinflation occurred as fast as it did, because I think they were hell-bent on destroying, creating a high level of unemployment that would have been disastrous for not only our economy, but for the individuals who would have been so badly affected by those policies.
Let me just add something here. It's something that you both touched upon. I mean, let's think about this. The current model is that it's okay to create unemployment. It's okay because it's going to bring inflation down. And like you said, we've got to find a better way or more humane way of fighting inflation. And it goes back to the question I asked about the use of fiscal policy and some of the programs that the professor mentioned. I'm really happy that you answered that question in that way. So I agree as well. Thank you.
Thank you, Professor. I want to go back to the discussion on the necessity of a crisis to prevent the inflation. Usually macro tells us that after so many increases in the rate of interest, the economy should have crashed, but it did not. So I want to ask two questions now. Why the US economy is proving so resilient while the neighboring country, Canada, is not doing so well? And another question is, have we achieved a soft landing, or is it too early to tell?
So in terms of the US compared to other countries, I mean, this is something that I've been kind of delving into a little bit more recently. And I mean, it's an important, that's a good way for us to get some sense of the differences across policy. My go-to in a lot of these is, well, we had the rescue plan and nobody else did, right? So that's one piece. I think another, and again, these differences across countries, there's absolutely, you can't compare the Canadian labor market exactly to the UK market to the, I mean, so there's always going to be those kind of differences. we had differences in fiscal to push the recovery. There are ways in which different economies have interest rate sensitivity. So the US is one where it's 40-year fixed mortgages. We also, because of the fiscal, there was a down payment on, like I said before, a lot of the debt, low delinquency rates, cash flow was good for businesses. So like if you don't need to take out a loan, that interest rate is not that important to you. Whereas other countries that have varying rate mortgages or other, it could just be the mix of, the how interest rate sensitive you are. However, in the US, if you look at interest rate sensitive sectors, it's clear that those rate increases had an effect. Like you can see, it may not be exactly what we thought, and maybe housing's coming back. Yeah, I mean, but in general, you can see that the Fed is doing something to the economy. It's just unlike in the past, it is not transmitting or hasn't yet transmitted in the way that we would have normally expected. I think that's, like I said, I think a lot of it is, we have a really strong labor market that's stronger than an interest rate. We have, household balance sheets are, the wealth of households in the United States across all kinds of demographic groups, income, wealth, the increase from 2019 to 2022 was historic. I mean, the data go back to 1989, but I mean, it was just like, wow. So households have a lot more of a buffer. So I think that's just a big piece of it. It doesn't mean that the Fed doesn't matter. Like it could be, it likely is mattering under the surface. Like no central bank controls the economy, right? It's like central bank can put some pressure down on the economy, but if there are other factors pushing the other way, then the economy keeps going. I think for the Fed right now, they're doing this awful thing where they want to delay rate cutting because they don't want to have to raise again or whatever, but they look to the economy being so strong and be like, oh, we have the luxury of time. Well, you can only hold up so long against, like, just because the economy has done well with the higher interest rates doesn't mean it will continue to do well. But again, I think looking across countries, there are differences in terms of how responsive to interest rates, how much fiscal was done, and then whatever pre-existing conditions we went into it with. The other thing that I don't agree with, but I'll throw it out there. So Fed Governor Chris Waller talked about one reason he thought the US was doing better, in particular the labor market, is, well, in the US, we just lay people off. And in other countries, there's more of an effort to keep employers on the job. And so he's a labor search person. So he's like, well, then the efficiency of, we rematch people in a more efficient way than before. So again, that's probably not the way I would think about our labor market institutions doing better, but there's got to be something in that space, in the labor market piece too.
So I agree with what Claudia said, but let me highlight a couple pieces. The first is the important role of fiscal policy. Not only did we have a stronger recovery plan that led to people having stronger balance sheets, which has provided greater strength to the economy. In the last 3 years, we've had some very big fiscal policy. The infrastructure bill, the IRA, the CHIPS and Science Act, and some of these have turned out to be much bigger than anybody expected. The tax credits associated with the IRA were expected to be in the order of magnitude something like $300 billion. Now they're estimated at $1 trillion to $1.5 trillion. So that's a big fiscal stimulus. It's spread over many years, but it's already taking hold. So I think that when you think about why we're having a strong economy, it's partly that we have stronger fiscal policy than other countries. The other fact that Claudia hinted at is that there are long and variable lags to monetary policy, and the full effect may not yet be there. Now, I think we are, to answer your second question, likely to have a soft landing precisely because we have such strong fiscal policy. Put aside some of the complexity of politics of America, where the gridlock, Americans might just finally realize that we have a dysfunctional political system, and what consequences that might have, I don't know, but I could certainly, if we were writing about any other country, we would say the dysfunctional politics is going to have a negative effect on the investment climate. That's what you would be reading in the financial press. We haven't seen that written about America yet, but who knows when we will get that, we'll see that in the financial press. But I think the other countries, we already are having hints. Global growth is estimated to be lower this year than normal. And Germany's in recession. They don't have the fiscal space, and their politics don't allow them to for those countries like Germany that do have fiscal space, to take advantage of the fiscal space they have. So the high interest rates are causing many countries in the developing world and emerging markets to have debt crises or debt problems, debt stress. So I think you're going to see the high interest rates showing up as problematic in many other countries around the world.
Thank you. And just to touch on something that Claudia said, I published a blog this week where I made the argument that in Canada, first of all, the deficit GDP ratio in Canada is 1%. It's 6% in the United States. So there's your Biden plan. But the second thing is 50% of all mortgages are flexible rates. And in June, about 50 to 55% of all mortgages will need to be renegotiated. These are people who had a 2.5% mortgage, and now they're going to have a 7%. So that takes up a big chunk. I've got friends who are paying $1,500 more in monthly mortgages payments right now. So spread that over, a great number of households. That's your drain on aggregate demand right there, plus your lack of fiscal response. One last question, and I want to say for us, it's been a pleasure, an honor, and insert any word there to have both of you here. It's been a great discussion. There's lots more to discuss, but I'm going to end on something that Professor Stiglitz, you said at your Tinbergen lecture 20, almost 25 years ago. You said a central bank must be accountable and sensitive to democratic processes. There must be more democracy in the choice of decision makers and more representativeness in the governance structure. Let me ask both of you, has anything changed for the better, or is there still work to be done in this respect? Claudia, do you want to start?
Let me let Joe go first, because he would know the
Okay, so it was a lecture. I was talking about the design of governance of an important institution, and we delegate to the central bank an important public function. And there's a whole theory, political theory, about the appropriate nature of delegation, the role of delegation, how you want some distance from politics, but you also want some accountability, and how you bring those two together. And what I suggested in that lecture, that we've gone too far on one side, and that, for instance, just one example, while even if you believe in an independent, relatively independent central bank, you ought to have more representativeness. That you ought, when they raise the interest rates, they affect workers, but where's the voice of workers? And so while you don't want them you may not want them in the to and fro of daily politics. You want them to reflect the concerns of our citizens. And I wasn't sure, in fact, I was quite sure that we weren't doing a very good job. Some countries do better. Sweden has a representative of workers on their board. Many other countries, not many, at least some other countries, have tried to make sure that Wall Street, financial markets, are not so represented because they have a special interest. And the way they think about things is very particular. And I think when we look at the United States, that concern is very real. I think central banks around the world have been cognitively captured by financial markets in general. And just to give you one example of cognitive capture, the financial sector is not as sensitive to conflicts of interest as the rest of us are. And you look at the question, who managed the Fed's portfolio and many of its operations, it was delegated to a very large private sector firm that is managing billions of dollars of other private people's money. Now, you say you can create walls and you don't use that information. Many of us think there are inherent problems of conflict of interest. Finally, let me say the evidence that independent central banks perform better is weak at best. In the 2008 crisis, some of the countries that managed well and avoided the crisis were Brazil and India, that did not have fully independent central banks. There are different degrees of accountability, but what I was trying to argue is that we've taken a too narrow a view of governance of the central banks, and we ought to have a broader democratic reassessment of how we can make sure that the decisions made by this very important body are more fully reflective of the interest of everybody in our society.
Yeah, thank you.
Okay, so I'd say on some dimensions, the Fed has made progress. I think, but accountability, like fundamentally, accountability is difficult. I mean, though it should, in theory, should be straightforward. Congress, well, first I'll say, no one on the FOMC is accountable to the American people, to the electorate. Like, they are not voted into office. They are appointed by the president. They're confirmed by the Senate, or nominated by the president and confirmed by the Senate. And the Senate created the Fed. So even bigger than who gets to be on the board. I mean, the Senate created the Federal Reserve in 1913. They have gone in 14 times and amended the Federal Reserve Act. So it's not like the Fed just has carte blanche and they can do whatever they want. I mean, Congress will take away powers, give them powers. Frankly, they've given them a lot of powers over time. So there is an accountability piece, and yet you can argue that the Board of Governors, because it has this direct, it has to be confirmed by the Senate, is a little closer to the people because Congress is close to the people. Where I find the part of the reserve system that I find most problematic on many of the dimensions Joe just mentioned are the Reserve Bank presidents, which are never a voting majority of the FOMC, but they are they're the majority of the participants, right? So they do get a seat at the table. The Reserve Bank presidents are essentially put in place by the banks in their district. I mean, it's more complicated than that. The banks they have a board of directors and they have a majority role. But the idea that you have any financial market institution having a bank, which the Fed oversees, that the banks and the fight are having a role in who serves on the FOMC is just mind-boggling. Like there is no definition of conflict of interest that wouldn't grab that one, right? So there's just a governance structure that doesn't make sense in terms of being accountable to the people, and remembering that the decisions that the Fed makes, they affect hundreds of millions of people, right? So they're making big decisions. They don't have a direct accountability to it. And while diversity in some senses has improved over time, I mean, the Federal Reserve Board or Fed right now has reflects more of the diversity across the population in terms of particularly race and gender. We're still not there, but it's much improved. But frankly, like we still have way more economists than we should have. There's no workers group who's represented. It's really not community. Like it's really a very homogeneous group on a lot of dimensions, and very finance. Right. And just from a staff perspective, like the most, and actually you see this on the FOMC too, it's the to Wall Street and back, or from the Fed to Wall Street in terms of the staff and the thinking. That doesn't necessarily have to be a bad thing, but it does mean, like you said, there's just this mindset that is so financial focused, which they should be to some extent. Monetary policy works through financial markets. They need to oversee banks, financial stability. And yet, like that mindset looming too large makes it very hard for, I think, them to do one of their two big jobs, which is maximum employment. Like you need people who are kind of connected to Main Street to see like both of those goals, inflation and low unemployment, those both matter. So
can I just add 2 points that as Claudia has discussed it, came to my mind. The first is this problem of conflict of interest got brought out very clearly with the bankruptcy of Silicon Valley Bank, where the president of the Silicon Valley Bank was on the board of the San Francisco Federal Reserve. So that really highlighted to a lot of people the kind of conflict, and obviously the San Francisco Federal Reserve hadn't taken its supervisory responsibilities adequately. The second point is the framing, the sense of accountability that the members of the board take. And I think this is where the economics profession has had done a disservice. A lot of people in the economics profession keep emphasizing independence, 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 as if it's the holy grail of good governance in monetary policy. I remember one of Paul Volcker, who I sometimes disagree with on monetary policy, was very clear about his sense of accountability to the citizens and to the, what he said is, Congress created us and Congress can uncreate us. So while he knew that he had been delegated responsibility, he also knew that he was doing that on behalf of all of Americans. So even if you don't think his judgment was right, partly influenced too much influence from the financial market, he understood the notion of accountability. And I'm not sure that many of the people, all the people on the Fed have that sense of civic responsibility deep in their blood.
Thank you. Thank you. That brings us to the end of this this chat. I thought it was a fantastic chat. I could go on for hours, I swear. We touched upon issues that I want to develop further. But thank you very much, both of you. Thank you for Sylvio for helping us. Thank you everyone for tuning in, and hopefully we'll do this again sometime. Thank you very much. Bye-bye.
Thank you so much. Bye.
Bye-bye.
Bye.